Hey guys, and welcome to today's video. You are here with Ben and Connie.
Hi guys, today we're going to go through the prime method. Ben, tell us what we're going to go through.
So Connie, the prime method, really it's a method of analysing your finances and then analysing what you can do in order to be in a different financial position in the future. Now, we all start off from the same position and we're going to show you in full detail exactly what it looks like.
Yeah.
But then we'll also go through and then we'll see there's 3 different avenues that we can take. So what are these 3 different avenues and you know, what are the changes we need to make in order to live that life?
We have 3 people. You're going to easily see where you fit in. Which person are you? One person is doing really well in terms of finances and the other person may be slacking a little bit. Yeah. We're going to see the big difference and how you can achieve and reduce that difference in your own lives.
Now, let's jump straight into this. Connie, explain, what is it that we're currently looking at here?
So here you can see we have the prime Excel file. Now, this is the file that you are going to customize to your own personal selves. It's going to be all of your current finances and also your projected finances, which we'll come on to later. Yep. But here we want you to go through and have a look, enter everything that you can see here, and we're going to go through each tab individually. So first one is P. This is your preliminary actions. Now, we have monthly income. We're keeping this at 5,000. Within our 5,000, we have our rent, we have our monthly savings, we have our car expenses, and we have other variables like going out, clothes, cigarettes.
It's also worth noting, guys, these are not the main, or these are not the only expenses. There will be some other stuff which we'll come on to later, but really the rent, the expenses, you know, in terms of your variables, the savings in the car, those are the 4 main cornerstones that really determine someone's financial well-being, you know, not just now, but also if changes are applied to these areas, then it gets really interesting because we really see the capacity for growth once you kind of look at these key areas.
Exactly. And so what we're going to do is we're just going to go through each point and we have put a target and a minimum for each. Now, this is going to be different depending on your specific situation, but for us, we've got a maximum of 30%. So in terms of our rent. So at the moment we're 1,000 out of 5,000. This is 20%. So we're in yellow here, and we have a color-coded system here.
It's like a traffic light system, isn't it?
Exactly. That's the word I was looking for.
Yeah.
So you have a color-coded system. You've got orange, red, and green. We're not quite hitting our target here of 30%. So we need to think about how we can change that. We're going to come on to that in a bit later. But our target is 15. So we then can go on to monthly savings. Our target is 80% and our minimum is 30. So we're not close enough at the moment.
Yeah, and it's worth noting, guys, you know, we appreciate for those people on a slightly lower salary, it could be that your rent won't necessarily go below a certain level. And even with the rent, if it is that you take a mortgage out and you're paying this, you know, it's okay to pay off slightly higher on a mortgage because you're paying yourself and therefore you're having an appreciating asset as opposed to something like, you know, spending £1,000 per month on a car, which is a depreciating asset.
Yeah.
You know, and it's really about understanding the different types of assets. But yeah, sorry, carry on with the savings because you have to be in a good range, don't you?
Yeah, so it's all about creating these ranges. And again, the target of 80% here may be a little bit too high for you. In terms of where you are in your career, maybe 80% is something that you can think of 5-10 years down the line. Maybe 50% is better for you. Whatever your target is, you can change this, you can amend it, make it your own. We really want you to make this personal to you. Again, we're going to come to our car. Our maximum is 2% and our target is 1%. Now, 1% sounds crazy, doesn't it? It sounds really low.
Yeah, but I mean, the key thing is if you buy your car, then your expenses, you know, you're not paying for rent on it, which means that again, you know, although it is a depreciating asset, so you know, it's something that you have to be aware of, is if you know you're spending 1%, maybe 2% on petrol maintenance, you know, you don't have to get a sports car with, you know, extremely high maintenance. But if you can get one where you're only paying for the, you know, cheap maintenance, bit of petrol, and then you sell your car, you can then have a huge, you know, influx of cash, which can then be put into your monthly savings or into, you know, any dividends or, you know, buying an appreciating asset as opposed to, you know, holding onto a depreciating, which most people kind of get wrong, don't they?
Yeah, it's definitely a common thing for everyone. Their largest expense is their car. And we're going to see in a second that the car, the whole situation with your car is the area where you're very quickly going to be able to reduce your expenses. let's keep going before we come on to the next tab.
Yes.
So variables, again, we have a maximum of 15 and a target of 10. We're not hitting it, we're 20%. We need to think about the actions we can take here to reduce our expenses and hit our target. We then have our assets. Now here we have a bank, we have our cash. This is usually where you're going to be getting around 0, maybe if you're lucky, 0.5, 0.75%.
Yeah, it's very, very rare. You know,
not much.
Typically an ISA, isn't it? Where, you know, you park your money, you feel safe, and, you know, it's a good thing to at least put some money away, you know, but we'll see in the next slide that it's really not as safe as what you might think, is it?
No.
Which it really is a lesson that everyone needs to be able to learn. But
For sure.
Yeah,
Yeah, we'll definitely come on to that.
Yeah.
And we have the stock market, whatever you have invested. This person has £5,000. We have our property. This is a very high ticket investment, so it's always going to skew your portfolio, but it's a great investment in terms of longevity. Yeah. And then we have private equity, which is investing into companies which have not been listed on the stock exchange yet. Very risky, but very lucrative if it goes your way, if it goes well.
Yeah, I mean, think about early investors of Uber, Microsoft, Amazon. You know, all of these different companies. They have worked out very well. And I saw a story the other day, and it was about the third co-founder of Apple. And if he hadn't sold his 10% stake, it would be worth over like nearly 200 billion or something like this.
Really?
Yeah, it's absolutely crazy. And you think, like, you know, obviously that was a private equity deal. He sold his shares for $800.
Whoa!
What an idiot! But obviously, it is very risky. And if you're involved for the long term, your cash is illiquid, so you can't access your cash because obviously it's stuck in the business. But it can be highly profitable.
Very highly profitable. Just do your research.
Yeah, absolutely.
Okay, so then we come on to the list of goals. Now, again, this is all down to you. This is your goals. We've just put a couple of examples here. So we have increase our monthly income by 20%. If you want to put a timeline on that, you can say maybe by Q2, by the end of the year, whatever you want.
You have to keep yourself accountable on that.
Exactly. And we want you to approach your finances like a business. So this is essentially a business plan for you to see your finances, achieve those goals, make miniature little goals in the middle to achieve the larger goal. If that makes sense.
Yeah, absolutely.
And again, we have make your first $500 via the financial markets and trading. Trading's a very hot topic at the moment.
Yeah, everyone's excited. It's highly, there's an awful lot of opportunity because obviously, you know, there's two types of investing. There's long-term and short-term. Now, when we look at long-term, that's like a Warren Buffett type style of investing. You know, value investing, you purchase and then you hold it for a very, very long time. Perhaps you get dividends paid, and we can explain what those are in a minute. But trading is more so you can make money when the stock goes up, but you can also make money when the stock goes down. Yeah, so you can get paid on pretty much any market conditions, but you have to know what you're doing, which a lot of people don't, do they? So obviously that's where you
need a lot of training.
Yeah, you do need a lot of training. And the people who were inside our community, they get a lot of training, and they can be very successful. But you have to kind of put the time and effort in to develop the skill first.
Exactly.
It's a skill. It's just like being a doctor or something like this.
Totally. It's an essential skill.
Yeah. So do your research. But then the final goal is acquiring a secondary property. I mean, it could be your primary, whatever it is that you have, as you said. We'll customize this, and we have a goal there as well and a timeline so that we know, okay, this is what we need to achieve by this particular time. So that we're not just saying, oh, it's fine, I'll do it in 10 years. Because it's easy to put that off till tomorrow.
Yeah, for sure.
I know when I try to go to the gym, I say, oh, I'll lose this much weight by end of the year. I'm like, well, if it's by the end of the year, I don't have to go today, do I? I can go tomorrow. I can go the next day.
Yeah.
And then it comes up and you've lost. You get fat.
1 pound.
Yeah.
Totally. Okay. Moving on. Let's go to tab R. So here we have our reflections. Now, we've had a quick talk about the actions you can take in order to achieve the target goal that we had set in the previous tab.
Correct.
So here we're going to break it down. So we have, first of all, our cash flow. This is our total income and our total expenses. Now, here we have our current column, and here we have our planned column. Now, this person is, you guys are going to go through this and where you are currently. You're then going to look at this and think, where I want to be, maybe by the end of the year, maybe by next year, maybe 6 months, whatever it is that you want to do. And then we're going to go into the income and the expenses and the changes you're going to make in order to achieve the difference between your current and your planned. So, Ben, you want to go through through income?
Yeah, absolutely. So the key thing really is with our income, we need to, well, the overall view is we need to increase our cash flow. There's only really two ways that you can do that. You can either increase your income or you can decrease your expenses. So to increase the income, you can see currently we have, in this example, we have a job which is paying £4,000 per month. And then we also have a little bit of money coming in from our property dividends. Now, these dividends, it's a rent really. So you have a tenant paying you, and that's generating this guy 600. Plus, we get a bonus. So a bonus from our active is commission. It's it could be a bonus structure, whatever it is. Some kind of incentive to if you hit your goals. So we have our active. That's our 9 to 5. That's the salary. It's what takes up most of your time. Could be your own business if that's what takes up all your time.
Yeah, exactly.
Like I said, we have the bonus, which is some kind of commission. And then we move on to the more passive ways to generate income. So the difference between active and passive, typically with passive, you do the work once and then you're able to get paid on that on a regular basis. Or you do the work, it's a minimal amount of work, but obviously you're able to earn a generous stream of revenue. So we look at the financial markets, we can see we have three different kind of categories here. Firstly is short term, just as I said last time, we have the trading, that's buying and selling stocks, buying and selling currencies, commodities like oil or gold, literally anything.
Crypto, big one at the moment.
Yeah, crypto, very, very good one. So that's trading, you make money on the way up, you make money on the way down, requires a lot of education, but can be very, very lucrative. And I know something that a lot of people do like in the UK, a bit of Forex trading and things like this.
Totally. And it's also a case of it's dipping in and out of the market. It's not a long-term investment. So you're not actually going to be affected by the big falls in the market and the big rises. The market's going to be going one way and you're going to be betting on the rise or the fall. So it's a really great, really good tool to be able to do to complement your long-term investments.
Absolutely. And also it's liquid. That's one of the key things, because guys, when we talk about liquidity is just how accessible is your cash. So if you have your, all of your money in your wallet, then it's going to be very liquid. You can access it immediately. But if you have all of your money in a property, for example, and someone says, oh, okay, you need to buy some groceries, or you need to, I don't know, buy a car or something. If you have no money, you have to wait, you have to sell your property, wait for the deal, wait for the real estate agent.
Weeks.
It's just going to take ages.
Weeks.
So you need to have that balance. And obviously trading offers you that short-term liquidity because you can just, cash out your money from your brokerage account, and it takes what, 24 hours?
It's 24 hours, yeah.
Yeah, exactly. Yeah. So very, very simple. Then we come on to, the second way of making money through the financial markets, and that is capital gains and dividends. So just like we said with Uber, Microsoft, and Amazon earlier, when we're talking about the private equity deals, with capital gains, that's where you make money, you invest early on, and then the company grows, and that then gives you a nice bit of money to ultimately to, I guess, cash out at the end of the, the end of the investing period.
And create a second stream of income.
Yeah, absolutely.
Second investment, third investment.
Yeah, and that can all then be reinvested again.
Yeah.
Now, and when we're talking about reinvesting, dividends are fantastic for this. So what we have is, let's take a company like Coca-Cola.
Yeah.
Big fan?
Yes.
Yeah.
Love a good Coke.
We all love it. We all love Coca-Cola. So with this, what they do is, yes, they've grown, yes, they're very big, but in order to entice their investors, they're not going to grow as much as, let's say, I don't know, Amazon 10 years ago. They have huge growth potential.
Yeah.
And they still do, to be fair. But Coca-Cola, they're already very well established. Now, what they do is they actually pay dividends. So every single year, they will pay a certain percentage. Let's say you give them £100, you buy £100 worth of stock. They then give you a dividend every single year. So then you have £100, they give you, let's say, 5%. You can then reinvest that. And then next year, you get 5% of £105. And then that's really where people like Warren Buffett, for example, you know, he loves Coca-Cola. Huge, you know, he's got a lot of his portfolio at Berkshire Hathaway is in Coca-Cola, and a lot of dividend-paying stocks, and that's how he's been able to. I think he's doubled his net worth, like over the course of something crazy. Like it's doubled over the past 5 or 10 years, and he's made most of his money only since he was 50, something like this. So it shows when he started so young, he didn't really make all of his money, but because of compound interest, he's then, you know, now very rich.
$1 billion.
Yeah, more than a billionaire. So I don't know the number, but he's very, very rich, and it's always changing.
And just to add there, so Coca-Cola is one of the dividend aristocrats. So we talk about these companies that are increasing their dividends every year. Now, it's also McDonald's, that's the word. I eat plenty of McDonald's, I couldn't remember the name. McDonald's, AT&T, all of these huge companies which have, for the past 25 years, increased their dividend on a yearly basis. So we have a list of these. You can find them in the links. Go ahead and look or do your research, because these are great companies to invest in to ensure that you're actually going to get your dividends and be able to reinvest them into another investment or another stream of income. Yeah,
absolutely. That's a very, very useful link. Thank you for that. So let's look through private equity. That again, another passive income. Connie?
Yes, so we have private equity. We have your dividends and your capital gains in exactly the same way as the stock market. The only difference is that these companies won't be listed on the stock exchange, as I've already said. So with all of these different monthly incomes, the aim of the game is to increase your number of incomes so that you can diversify. You're going to be getting dividends, which is every year, so you're going to be able to reinvest. You're going to be getting the capital gains on the appreciation of the asset, which you then can reinvest. And it's a case of whether you want to reinvest into the same investment. So if we take property, if you want to reinvest your rent into the property, or you want to remove that investment, remove the rent and reinvest into something else. So that is the most amazing thing, is it's so much easier to have 10 streams of income, slightly smaller, than have one huge one. So this is what we want to try and get you to think about. Having more than one is way easier, don't you think?
Yeah, absolutely. No, you're 100% right. And we can even see, if you guys just have a look at the plan section here of our monthly income. So we haven't done a huge amount. We're very simply just, you know, adding in a few revenue streams. So obviously there's one from property, which, you know, we already have. We just say we're going to increase that. Maybe we buy another property. Maybe we get a different tenant who's paying more. Maybe we just, you know, take a small bit of money and we do up the current property we have. Then we begin trading and we get into the financial markets. So obviously investing short and long term. And obviously we can help you guys with both of those. Now, those small changes that we've made have actually resulted in £3,000 difference, which is, it's huge. And just like you said, it's so much easier to create smaller streams of income, you know, many of them. And also it's better for diversification.
Absolutely.
If you got all in to be a doctor, for example, and then you get fired, you have a high earning potential, but you have no job. And you know, so if in this case we get fired from our job, we still have other things to be able to help us. And everyone's worried about that. It's something we need to be aware of. You know, with COVID, everything's very, very uncertain. And you know, luckily we're hopefully coming out the back of it.
Yeah, I think so, yeah.
But there's still massive amounts of uncertainty, you know, in the market, and we need to be aware of that.
For sure. So when we actually look at this and we're talking about the difference, and the difference is only 3,000. Now, this isn't going to, well, this is for total income, is going to create a £3,000 gap. But here, cash flow, and here we're looking to reduce our expenses. So the aim of the game is not only to increase your income, but also reduce your expenses. It makes life so much easier. So how are we going to do this? What are we actually going to look at to achieve this? So again, we have exactly the same way as what we've done with income, but we've done it with expenses. So we have our current, and you can fill this in yourself, and then what you want to be in next year. So we have our normal things. We've got rent, we've got food, we've got your telephone bill, your travel. Write everything down. You can add, you can take away. Maybe you don't have a pet, remove it, put in whatever you have. And what we're going to do is, so here you can see that car and travel is a large expense. Now, we spoke about a car in the previous tab. It's the easiest way to reduce your expenses. Honestly, the easiest way. So we have decided to sell our car. Our car was a Mustang. We now have a Ford Focus, whatever. So we've reduced it. We've got 450. We've decided to also pay off our bank loan. Our bank loan is finished. We now no longer need to spend money on our bank loan. And then we have a few other small things, but usually you can't really like change that much.
Yeah,
so,
like even if you're living in London, for example, your rent really can't really go below 1,000, and those things you don't have to think, oh, I'm going to live under a bridge. You obviously still can live your life, but the key areas, like we say, with the car, the bank, and then finally the variables.
Yes.
Those are only really the three areas that we change, and once we change those, we have a huge impact. It's extreme.
Yes. We have over £1,000 difference. Yeah. Now, you don't have to do this. This is for a person who wants to be a good investor. This is for a person who actually wants to achieve a goal after a certain amount of time. Now, we are all in the finance industry. We want to be able to retire at a certain age. Now, you can go ahead and increase your income, but these are just really simple ways to reduce your expenses. It just means you have more to invest. That's essentially it. If you want to be a savvy investor, you can do it yourself. It's a really good way to approach it.
Yeah, absolutely. Because retirement, guys, it's not a particular age. I think some people in the UK get a little bit caught up in terms of, well, I'm going to have to retire at 65 and I'll get a state pension, which is like £100 a week or something like this.
£120, something like that.
Which is monstrous. Just imagine yourself right now. How could you live on that? Like you just couldn't. And so, the idea of people saying, okay, well, I have to retire at this age is crazy. We need to take more control over our own lives.
Yes.
And we need to. I need to take control over my voice at the moment. I can't. But take control over our own lives and realize that really just when your expenses are matched by your passive income, that's when you don't have to go to the 9 to 5.
Yeah, exactly.
So the quicker that we can get to that point, i.e. the quicker we can get an extra stream of revenue, the quicker we can reduce our expenses, then we can meet that stage much sooner.
Yeah, for sure.
And you're then able to retire, do whatever you want. And retirement shouldn't just be about saying, hey, I'm retired. It's what do you really want to do?
Financially free.
Yeah. Do you want to go spend time with your family? Do you want to go and, travel? Do you want to go and, what would you do if you were retired?
Travel the world again.
Yeah. I'd say, travel, spend time with, people who you like. For me, big into motorbikes. So, I'd probably just go and ride a motorbike everywhere. but it's about, being able to have that freedom that's really key.
Yes, and you need to ask yourself, what is your why? What are you doing this for? Why are you investing and why are you wanting to save for the long term? What is your end goal? What is your why? So you can visually see the difference and the impact this has made. So your monthly expenses, it's come down. Your monthly income is going to go up. And this here is your monthly savings. This is your cash flow. And the difference is crazy. This is what you're planning to make by the end of the year if you put in your actions that you have described and you have set yourself here. So it's huge. We haven't done that much.
No.
We really haven't done that much.
No.
It's the same person with a couple of changes. So the real impact we're going to see now is on the next slide when we see 3 different people. They've all started in exactly the same place as your current and your planned. And all the difference is the investment side. So Ben, tell us about the 3 different people quickly. Yeah,
so 3 different people, they all start at the same position. This is crucial. So they're all, just like me and you, we have our 5,000, we have, whatever it is that we put through. It's all exactly the same. They just take 3 different paths. So really, we end up with 3 different future self. And so one of them is Nelson, one of them is Peter, and one of them is Jake. Now, Nelson, he has continued to save, but he hasn't really listened to, adding an extra stream of revenue. He hasn't really decided to invest, and he hasn't really decided to decrease his expenses. Maybe he's a bit too comfortable. He doesn't really care, but we'll see he kind of pays the price.
Yeah.
Peter, he has actually invested, and he has decided to kind of put his money away, and he's learned about the power of investing. And then we have finally Jake, who has done everything. He's invested, he's increased his income, he's reduced his expenses, and he is living a great life. And we'll see exactly why. He's living, what was it, 4 million great lives.
Yeah.
So we'll see the power of this. But firstly, Connie,
yes.
What's the AX equals Y? What does that mean, and how can we take advantage of this?
So this is the golden equation. You need to put this on your fridge, put it on your car dashboard.
Tattoo it on yourself.
Tattoo it. Don't crash in your car though. You need to really learn this equation, because beginners, they usually only look at how much money they're going to make on their investments. Now, that is the downfall of a beginner. If you're slightly more savvy, if you've gone through this prime method with us, you will know that you need the full equation. So the full equation is AX equals Y. Now, A is your cash flow. A is the amount of money that you have to be able to invest. Now, we've seen in the previous slide how you can increase your A, which is by reducing your expenses and increasing your income. This is the key. Everyone always seems to look at X. X is the multiplier.
Yeah.
X is the 10, 20, 30% that you're getting on the stock market, on your property, whatever your investment is. Now, these percentages are definitely achievable. You can almost guarantee you're going to get between 10, 20, 30% on the stock market.
Yeah.
But by focusing on this, you're actually going to be taking more risk. It's so much more simple and effective to say that you're going to achieve 10%, which is what we think, and what as a company we look to achieve
it's
10% over time.
Yeah, it's good. 10% is usually that's the average market return.
Yeah.
We can we'll show you in a second, but 10% is the average market return. So it's very very doable.
So achievable. Sometimes it's actually underachieving compared to the stock market. We'll show you in a minute.
Yeah.
But we have X. X we're keeping at 10%. That's it. It's going to stay 10% for 40 years. And then we have our Y. Y is what we are going to end up with, say, in 40 years, if that's when you want to retire.
Yeah.
And so to just have a look at the stock market and the returns that we've had over the past 10 years, we can see here we have the S&P 500. Now, from 2012, we said you're averaging around 10%, and you can see that here. It's actually 13.41. Then we have a huge return in 2013, 29.6.
Yeah.
It kind of falls down a little bit. You had a minus, but then up to 9.54, up to 19.42. You can see here that we may be overshotting 10% and then a little bit under, but you're averaging about 10, 12%. So it's so achievable.
Yeah, and because we're not worried about the immediate changes, we're not getting upset when we see in 2018 that we're down by a few percent. But then we're also not, celebrating and selling everything just to cash in when we get, 30% in 2019.
2019, yeah.
Well, because this is the long term. That's what we're focusing on, guys.
Yeah.
It's our retirement plan, really, isn't it?
Yeah, it's this money that you don't need right now. It's money that you need in 40 years' time. Don't invest your money that you need now. You need to have your liquidity, and you need to have that separate to your long-term investment.
Yeah, absolutely. So 10% is very, very doable. One thing that you guys should take aware of, there's a lot of people out there who will say, invest in this and we can get you X percent. And that's the problem with the industry, is that people focus on the X too much, just as you said, Connie.
Yeah.
And I think that then leads to a lot of people just focusing only on how much of a return can I get? How much can I get? And if there is a greater return, there's also a huge risk. So
for sure.
Same as, like we said, Amazon, Uber, Microsoft, they're all very successful. But how many companies out there have gone under, have been promising, but then just gone bust?
Yeah,
too
many.
Extremely risky. So you have to be aware, if there's a high return, there is also a high risk. So that's why 10% is the perfect level for us.
Ideal.
So firstly, let's now look at Nelson. We'll see what has he done. Connie, do you want to walk us through Nelson?
Yes, so Nelson is our first guy. So Nelson, he has 5,000 in the bank, in his stock, and he has had a return for 20 years. He's ending with 33,000, just nearly 34,000. He has his 35,000 in the bank, and he has his current savings as 12,600, which we had seen from the previous slide. So this is Nelson.
Yeah.
He's not doing anything different. He's being a good guy, and he's still saving every month, which is amazing.
Yeah.
And he is investing what he has in the stock market and continuing to invest. Now, he hasn't achieved any income, any investment return on his savings. So he's ending with £320,000 after 20 years.
Yeah.
We then have a look at Peter. Now, what is the difference between Nelson and Peter? So the only difference is that he has his 12,600 and he's invested it. So he's getting 10% return over 20 years. So he's getting nearly 800,000.
Yeah.
But he still has his 5,000 in the stock market and he still has his 35,000 in cash.
Which he has then invested. So he's invested pretty much all of his savings. So
yes.
He has his 5,000 and he obviously sees over the course of 20 years, if I can go from 5,000, in the first 10 years, yeah, he makes an extra 7,000, that brings him up to 12,000, was it 12,900, something like this?
12,000.
But then from 10 years to 20 years, again in the same 10-year time period, he's not gained 7,000 as he did in the first 10 years, he's gained an extra 20,000. So that's really the power of compound interest and why, when we look at the long term, it's unbelievable. So we need to focus on that, and Peter really has. So everything he has, he's invested it, he's getting 10%, which is a very decent return.
Decent.
Very doable, and he's kept that over the course of 20 years. So he's then ending up with $1 million.
1 million.
Yeah.
which is, he hasn't really done anything different. No. Like, Peter and Nelson, they're the same person.
Yeah, hasn't changed any spending habits.
Nothing has changed.
No.
All he's done is put his money to work.
Yeah. So
literally it.
Yeah, that is it. Very simple. And now Jake, what he has done, if we just go back onto the other slide, we can see that he hasn't just, not changed anything. He's thought, okay, hang on. I know where I want to be in a few years. I know that I don't want to always be working and doing this and whatever. And so he then decides, okay, let me take some training. Let me actually listen to what these guys are saying. Let me plan and treat myself like a business. So treat my finances like a business.
Exactly.
So he goes, he increases his revenue, he then decreases his expenses, and like we said, he's increasing his cash flow.
Yeah.
Then what he does is, if we go back on, we see that he invests everything, but he's not just investing the 12,000. He's investing a 64,000 because he's reduced his expenses and he's increased his income. Now, what's the result of if we actually take these actions that we think are very doable?
It's phenomenal. Like, honestly, when you look at the numbers like this, it just makes us think, why wouldn't we do this?
Yeah.
Why wouldn't we do it? Because it's just so simple. All he's done is he's reduced his car, he's changed his car, he's reduced his expenses on the weekend, and that's pretty much it. There really isn't that much difference. And then he's invested elsewhere and diversified his portfolio. You can see he's gone from 1 million to 4 million. Now, 4 million is an insane amount of money to be able to retire on. Now, which person are you? You can literally see here, go through it yourself. Which person are you right now? And what are the actions you need to take to become Jake? We all want to become Jake. That is the goal here.
We do.
So how are you going to do it? You can see Nelson, he didn't quite understand the equation. Maybe he only understood X. We have Peter, he didn't quite understand the equation either. He focused on X, he was getting a good return on his investment, but he didn't think about the Y, about the A. A stayed the same. He didn't change his expenses and his income.
And one key thing is, what's the point in having a crazy high X if A is zero?
Like, you don't have anything to invest. What's the point?
Yeah, like 100 times zero
is zero.
Yeah, so you need to make sure you actually have something to invest in order to actually get your return. And then Jake, he's just understood everything.
He's mastered the entire equation. Jake has done it all. He's increased his A, he's focused on X being at 10, and this has resulted in a huge pot when he comes to retire. So these are the numbers. You can see them plainly for yourself. Play with them, fiddle with them. You can see over time, put your own numbers in, and it will be a really great tool to be able to see how your potential income can increase over time. Yeah, and guys, the one thing that's really crucial here is you might think, oh, I'll just put my money in my ISA and I'll keep it safe and I do it. It's a good idea. It's good to save, I should say. You get in that mindset of regularly putting money away, which is a very, very powerful mindset to be in. But the one issue that we do have is inflation. Yes. Now, I mean, there's loads of examples. There's Germany just after World War I. There's Hungary. There's Venezuela. There's all of these different countries that have just decided to print as much money as possible. But it's led to hyperinflation. We have, I think it was Zimbabwe in Africa. Yeah, it was. You take a wheelbarrow full of your cash,
and go to buy some bread and someone steals the wheelbarrow because it's worth more than the actual cash inside it.
Yeah, quantitative easing is not a good thing.
No, and guys, we have to be aware. If we look at the global reserve currency, which is the US dollar, it's like 20% or something of all money in circulation has been printed within the past year or year and a half, which is worrying. It's really worrying.
And it means that we don't necessarily see the value of our money going down. So world inflation right now is between 2 and 3%. We don't necessarily look at our bank accounts and see that our money is going down 2-3%. It's not visible. It's a silent killer.
Yeah.
So when you go to pay for, you go and buy milk, you go and buy bread, that's when you see it. When everything is actually becoming more expensive, the value of your money is going down. Now, it's not easy to see. So people bury their heads in the sand, and maybe in 40 years' time, when they look back and they think, God, I wish I'd actually done something to protect myself from inflation, because it's too late by that time. It's too late to do anything then. Yeah. You've actually ended up losing money. Like
Nelson is a great example, yeah.
Yeah, exactly. So even though Nelson thought he was doing a great thing, he was putting all of his money into savings, he was holding it in cash. But what actually happened was that he just lost nearly £100,000 to inflation.
It's tough to swallow that, isn't it?
Yeah, like when you think in 40 years' time and he gets told that, he would have thought, God, I wish I'd done something.
Yeah, like imagine if someone says to you, yeah, you can keep your money, you keep it safe. We're the bank, we'll save your money, but we'll take 100,000 over the course of 20 years. You'd be like, well, actually, hang on a second, no, I don't want that. I want to be able to earn. And guys, like, it's about taking action now. It's about understanding, okay, this is real. It is happening around us. We know that everything's more expensive. I mean, when I was younger, a Freddo was like 5p.
Yeah.
I don't know if anyone's ever bought a Freddo now, but it must cost. Probably have to get a mortgage out for it. But that's just one example of inflation and everything getting a little bit more expensive, and your money losing purchasing power. So we've put together educational training for the short-term investing, which obviously is trading, and also for the long term. So there's links down in the description. There's links that we've sent you guys. So make sure that you actually use those. And being based in the UK, I believe both of them are free, aren't they?
Yep, definitely, 100% free for you guys.
Yeah. So make sure you actually take action, and don't just sleep on this information. It's so valuable. You have to make sure you can actually take the benefit from it, and you're the only ones who can change your life. It's it's not my money, so I know I'm doing what I need to do in order to try and become Jake. But for you guys, it's your money, it's inflation, and only you guys can be the one to change your path.
Exactly, very well put.
Yeah, so we hope that hope that you do, and hopefully then your kind of the graphs that we see below will reflect your life.
Yeah, so this is just a very quick visual representation of what we've gone through. You have your stock market, how you've got 13%, and you've got your bank cash, which is 87%. We've got too much in cash at the moment. Yeah. It's not at work. So you can very quickly see that something needs to change here. And then we have this is just showing, is it really necessary to invest? Like, is there any point? And here you can see it's just unquestionable.
Yeah.
It's just whether the method that you want to take to do it, how are you going to do it? Do you want to invest short term? Do you want to invest long term? Now, our company, like you said, we have 2 really great, really good trainings. Yeah. So you can take the questionnaire, you can decide what is best for you. You want to go long term, want to go short term. Take your own path. Yeah, thousands of people have done it, and obviously, seen a lot of benefit from it. But also, it's really good to have an allocation of both. You need to have typically around about 20% short term and 80% long term. Yeah. So that 80% long term, like we said, is illiquid. You're not going to access it. Your 20% is, that's what you decide to actually invest in the stock market. You can win both on the upside and on the downside, as we went through earlier. But we would say, 20% short term, 80% long term. That's what us as an organization do. Yeah, for sure. And the other thing to say here is that we do believe in the 20-80% rule. And so when we have been talking about increasing the A, maybe you come into some money, maybe you inherit, maybe you whatever you do, you
Win the
open your own
lotto.
business, you win the lottery, whatever it is, you've increased your A. You want to rebalance your portfolio. So what we do is we rebalance we would then be on 90-10, and we want to rebalance it again to 80-20. So we like that statistic. It's down to you. Maybe you read some other research, maybe you like 50-50, whatever it is. But you need to rebalance when your A gets too high, and rebalance over time and over the course of your journey, because maybe 50% is better in 10-15 years time. So we have spoken about rebalancing your portfolio, we've spoken about inflation, we have spoken about the actions that you can take. Now we're going to look at tracking. We're going to see this over time. Now Ben, you want to quickly go over what we can see?
Sure. So we've kept it fairly simple as just a track record. We have a few different headlines here. So we have our passive income, we have our active income, and we have our total income. And this, in this case, has been tracked over the past 3 years. Now, guys, try and go back as far as you can. But we know that you're not always going to know, your savings in one particular year. But you can add in the highlights. Maybe you purchased a house. Maybe you decided to learn how to, get into stocks or whatever it is that you decided to do. And then we break these down. So we say, okay, what was our stocks for this year? How much did we invest in the stock market? How much did we invest in property? And then private equity and also cash. Now, we know ideally we want to reduce this cash and transfer the cash in the bank, which is kind of sitting there doing nothing and losing you money, and turn that into something that you have in stocks or in property.
Gaining a return.
Absolutely. And so what we really want to see is as the years go by, our total assets will increase, and we'll have a little note in there just to say, okay, this year it increased because I did this. Or I bought my second property, I took my first investment in private equity. Whatever it is. But it's really, really crucial for you to be able to look back in 5 years, 10 years, 20 years and say, okay, that worked really well. Because once you know what works well, you can replicate it, can't you? For
sure. And I really love this idea because I see this as like a time capsule. And I see this as, when I do look back, I can see, okay, I bought my first property when I was 28 or when I was 30. And when you've really gone so far, you appreciate where you came from. And I love that. I think that's such a nice idea. So this is what I'm going to really spend time on when we do it. And we have visual representation again, very easily see what years you've done really well. Maybe one year you didn't do so well, or here, maybe you sell your property. You can see your property assets have been going up, but you sell it and you reinvest it elsewhere, and you can see the difference in your investments over time. So it's just really simple. There's not really much more to go into on this tab, but make it your own. And it's really fun and satisfying to put through. Yeah,
especially when you track yourself kind of transforming from Nelson further into Jake. You'll then see that huge burst, and hopefully, these bars of cumulative wealth will obviously grow with you.
Yes.
So
hopefully you'll be able to see the actual point where you become Jake. Like that will be interesting to see.
Yeah, it would.
Okay, let's go on to the final tab, which is the evolution checklist. So this is you starting from scratch. You're starting today. You take this, you download it. It's completely downloadable, free of charge in the links below. It's yours. You're now starting your journey, and we're really excited to see how you actually progress. So we would love for you to share your progression on our #WeLoveARYA Facebook page. We have 7,000 or maybe 8,000 people already. It's growing a crazy amount. We've got 8,000 people today who have already started their journey with us. So join us, join them. You can chat, you can ask all the questions that you like. We also are putting lots of updates on current trainings and current videos. Everything is here to help you to learn and to grow financially.
Now, as we actually look through these different checklists, this really is the checklist for success. So if you complete every one of these, it's going to be very difficult for you not to be in a great financial position. But we can see you might prioritize different things. So you might love property. You might think, okay, I just want to have 10 properties, all generating income through rent, and that's what you're going to focus on. But it might be that you want to, invest in the stock market, invest in private equity, whatever it is, and you can customize this to really put in your own personal goals. But the key thing, guys, is you need to make sure that you follow these steps, you keep yourself accountable, And also, like we said earlier, you need to have dates on stuff, don't you?
Yeah, it's definitely nice to have data on. You have to reach that goal by a certain time, and if you don't, then you have to put more work in and more effort in to get there for that time frame.
Yeah, and it's extremely satisfying, like you said.
Yeah.
You know, to just go through and say, okay, actually, I've been able to do this, and I've been able to do this. And you can see where you focus your energy. Because, you know, sometimes, guys, we all know that we can, especially if we're going on a diet or something like this, we think, oh, I'll just do a little bit of walking here and, you know, I won't eat at McDonald's here. And it's good, but you're not fully going, you're not really attacking your goals. And that's really what we need to do in order to become Jake. Now, we also have the option to do this with investing. So we see we have long-term portfolio. We might want to generate 500 in annual dividends from our portfolio. So we have to allocate a certain amount in order for the dividends to come to 500.
Yeah.
We might then also want to go for the short-term portfolio, which is trading. So that's our, you know, kind of slightly more active investments, very liquid, make money on the up and the downside. And obviously it, you know, requires that extra bit of training, which is essential, but can be potentially more lucrative. Now, when we look at resources, we have the ability to kind of, like I said, go in and actually exercise this training. So we've said throughout that we need training. Now what we need to do, or what we want to give to you guys, is click on this link. You'll see two different sides. One will be short-term investing, one will be long-term investing. So on the short term, we teach you how to trade, we teach you about fundamental analysis, everything you need to know to come up with your own strategy. Then on the long term, we go through stocks, we go through the general market, we go through
aristocrats, like we already mentioned.
Exactly, dividend aristocrat type companies, everything you need to know to build and design your own portfolio.
Yeah, for sure.
Fantastic. So guys, make sure you don't sleep on this. I will say there was, what, 900,000 people?
Yeah, it went viral.
Yeah.
It was really cool.
we launched this, you know, in France. So there's a French version, 900,000 people. Obviously, they all saw the value. They want to become Jake, and they want to get access to the training. Now, we couldn't offer it to 900,000 people, unfortunately. So make sure that you guys do actually get access to this while it's still available. Now, we also have the XYZ/Share Prime. Now, this is just where you download it, you can share it with your friends, share it with your family. Most importantly, make it yours, isn't it?
Yeah, make it customizable to yourself and your own journey. We've said it so many times, you make it your own. We also have, when you do share it, and if you do share anything to do with the Green Bull Partners, you can actually earn income from it. So we've created this system so that you can do that and make money from it. So you can look at thegreenbullpartners.com and help change other people's personal finances. And then we have the My Club deal. What's the My Club deal then? Yeah,
so My Club deal, we just go out and we source the best property investment opportunities. You know, we've got a full team dedicated to doing it and a huge team of, I guess a huge base of investors.
Yeah.
You guys can join and very easily get into the best property investing deals out there.
Yeah, international. It's really great. Have a quick look at the link. Head over to our website, create your own ARYA account, go into the dashboard, see all of our trainings, see all of the upcoming coaching sessions, and really join the community. You'll be able to see everything that we have to offer, all the amazing tools. We have really great technical experts who have been chosen and who we certify through our company, who are giving great tips and great trading analysis and investment opportunities. So make sure you do that. We also have a list of our partner brokers that you'll be able to open accounts with, ones that we are tested with our company. You can download our ARYA app. This is going to be signals and really good in-depth technical analysis again. We have so many tools for you to take advantage of. Hashtag We Love ARYA Facebook page. Sorry to cut you off.
That's okay.
And then we have our YouTube channel. Just make sure that you take advantage of it all.
Yeah, and one thing I should say about the app is, you know, where we say we have 15 of the top investors globally.
Yes.
As we said, we've certified them. We've made sure that they are, you know, they are top notch, always giving out the best trade ideas, and we give you access to that again for free. Download the app. Make sure you have a look. Get some of their trade ideas. It might be a trade idea for a stock that you might want to invest in. It could be trade ideas for a short-term trading, on a cryptocurrency, on a stock, on a normal, currency pair, anything. So everything all there centralized. And obviously if you have 15 different guys to learn from, you know,
you've got to be excelling with that.
Yeah, exactly.
And another thing to point out, if you do have any questions, you can actually ask them directly in the chat. So it's a great tool for you to use.
Absolutely. So guys, you know, with all of this, we've been able to revolutionize people's finances. We really hope that you guys also get involved and join our journey. You know, it's what's allowed us to be featured in things like Forbes and Entrepreneur magazine. And, you know, we just want to continue and really help share this as much as possible. So like I said, don't miss out like some of the guys from the 900,000 who watched it previously. Make sure that you do get access to it, and make sure that you, you know, don't sleep on this opportunity just like any others.
Yeah, we wish you all the best of luck, and we really look forward to seeing you in the community. Take care.
Thank you.